Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner, owner of Elevation Financial. I'm on the web at elevationfinancial.com. Welcome. Today we're going to talk about a step-by-step guide to setting up a solo 401k for self-employed professionals. So if you're self-employed, business owner, setting up a solo 401k can provide you with a really powerful retirement savings tool. A solo 401k gives you a way to contribute both as an employer and an employee, which gives you additional capacity to maximize your retirement savings potential. It's a really powerful plan. So we're going to talk about where to start, kind of the mechanics of setting it up, and the ins and outs of step-by-step getting a solo 401k set up. Whether you're a freelancer, consultant, small business owner, we're going to talk through all the information you need to get one set up, and we'll dive into the benefits as well, eligibility, where to find contribution limits and investing and custodians, all the ins and outs, kind of the structure of how it works. So let's start with what is a solo 401k and who is eligible. A solo 401k is also known as an individual 401k or a self-employed 401k, and it's a retirement savings plan designed for self-employed individuals or business owners with no employees aside from a spouse. A spouse does not count against it as an employee. I should say no full-time employees. We'll talk more about that in a minute. But this retirement plan offers the same tax advantages and investment options as a traditional 401k, meaning kind of a big company 401k, but with the additional flexibility because the participant is also the business owner, which means you can take advantage of contribution limits on both sides of the contribution option. So to be eligible for a solo 401k, you have to meet certain criteria first. First, you must be self-employed or have self-employment income from a business that you own. And again, this can include freelancers, consultants, sole proprietors, small business owners. Second, you can't have any full-time employees other than yourself and your spouse. So part-time employees who work less than 1,000 hours per year can be excluded from the plan. So that's allowed. So really setting up a solo 401k can be a really great option for self-employed professionals because it gives you higher contribution limits compared to other retirement plans. And also provides flexibility to contribute, again, on both sides of the equation, employer and employee. So it gives you tax-deferred growth and a potential for tax-deductible contributions, which means that the money you contribute grows tax-free until you withdraw it during retirement. You can also have a Roth option, which means you can save more into a Roth account than is typically allowed by a Roth IRA. And a solo 401k is not subject to the income limits of a Roth IRA. So you can make as much money as you want, and you can still contribute to a Roth solo 401k. So it's a great way to get Roth money invested, even if you make too much money for a Roth IRA. So overall, it's a really powerful tool, helps you maximize tax benefits. So let's talk about the advantages in more detail. So a solo 401k gives you a lot of advantages. Again, we've talked about this a couple times already, both employer and employee contributions. So you can contribute up to the employee 401k max contribution for the year, which varies every year. So I'm going to say, look it up. I'm not going to say it because I'm not sure when you're listening to this episode. So basically just look up, 401k contribution limits and then the year that you want to look it up. So that's the employee side. As an employer, you can contribute up to 25% of your net earnings from self-employment or 25% of your salary if you're taxed as an S Corp. So the employer contribution can't exceed the total 401k limits for the given year, but you do have that additional capacity beyond just the employee contributions. So just a note that self-employment compensation is your earned income, which is defined by the IRS as net earnings from self-employment after deducting both one half of your self-employment tax and the contributions for yourself. So this dual contribution ability really sets the solo 401k apart from other retirement plans and gives you really significant tax flexibility. So another advantage of a solo 401k is its flexibility in terms of investment options. Unlike traditional 401k plans that you might get through work or through a W-2 job, who are often limited to a core selection of mutual funds that are very limited. In contrast, a solo 401k typically allows you to invest in a wide range of assets, stocks, bonds, real estate, even alternative investments like precious metals or cryptocurrency, because you're putting it in a custodian somewhere else, like not provided by your employer, but it's your own custodian you choose. this really gives you the ability to diversify and customize your portfolio. So the investment options will depend on the custodian where your investments are held. So be aware there may be some limitations. For example, certain custodians only offer mutual funds that are their own funds. Others will give you flexibility to choose from any number of mutual funds or ETFs or even alternative investments. So again, a solo 401k gives you pre-tax contribution options, which are tax deductible and tax deferred. And you can also do Roth options. Depending on the plan, most plans will allow you to do pre-tax and Roth. I shouldn't say most, some will. You want a plan that does give you both, ideally. So Roth contributions don't receive a tax deduction up front, but the money grows tax-free and can be withdrawn tax-free in retirement once eligibility conditions are met. So contribution limits and deadlines. So you want to understand the contribution limits and deadlines that go with a solo 401k plan. So again, just to recap, as an employee, you can contribute up to the current year employee max contribution for a 401k. So look it up for the year you're in. Again, just look up, 401k contribution limits in the year. That'll give you easy reference where you can find it. As an employer, you can contribute 25% of net earnings from self-employment or salary if you operate as an S Corp. But the total contribution can't exceed the IRS limit. So you want to look that up as well. So again, look up total contribution limits for a solo 401k to find those limits. It's pretty high. It's a lot of room you have. And again, I'm not giving you specific numbers because you might listen to this episode a year or two from now, and the contribution limits will have changed from this year. So that's why you always want to stay current on the limits. So the contributions have to be made by the tax filing deadline, including extensions. So for most self-employed individuals, meaning your LLC, sole proprietorship, your self-employed income, that's going to be April 15th of the following year. Or if you file an extension, typically October 15th. So you want to make sure that your contributions are in before that deadline to make sure they're valid. If you're an S Corp, you need to get your employee contributions in before the end of the year so that your payroll properly reflects the contributions. So if you go through payroll as an S Corp, that's got to be at the end of the year. All right, so let's go through some steps here. So step one, let's say you want to set up a solo 401k. Let's say you like the idea, it makes a lot of sense for you. First step is choose a provider. So it's actually, there's not necessarily one provider all the time. Sometimes it's an unbundled solution, which we'll talk about here in a minute. But a solo 401k provider is typically an institution or a custodian that has a specialized retirement plan called a solo 401k they offer. So there are two important components to a solo 401k, the plan documents and the investment custodian. So the plan documents govern the plan, and the investment custodian holds the investments inside the plan. And the two components can be bundled together or set up separately. So let's talk about plan documents first. All 401k plans, including solo 401k plans, must be governed by valid plan documents. So just like the regular 401k counterparts that you might see at a bigger company, solo 401k plans come with a set of governing documents that outline the specifics of how the plan operates. So think of these documents as the blueprint for the plan's design and administration. However, because solo 401ks cater to a different demographic, the documentation usually is a bit simpler. There's fewer participants. It's a simpler type of plan. So here is what you typically find in solo 401k plan documents. You have a plan adoption agreement. This is where the business owner establishes the plan and chooses its features, such as eligibility requirements, contribution types, whether it allows loans, rollovers, etc. So it's a customizable form that tailors the plan to the specific needs of the business and the owner. Also, basic plan document. This is the comprehensive rule book for the plan. Details operational and administrative guidelines for the plan, legal language necessary to comply with IRS and DOL regulations, covering basic operations of the plan, like contributions, distributions, and investments. A summary plan description. Even though solo 401ks are for a sole proprietor or business owner and their spouse, a summary plan description is still provided that summarizes the key features of the plan. A trust agreement. It's got to be held in a trust, ensuring that it's used exclusively for the benefit of the plan owner and spouse if applicable. And that aligns the responsibility of the trustee, who's typically the business owner, in managing the plan assets. If the plan allows loans, you might have loan documents as well that specify the terms by which loans can be made. There's a funding notice that can explain how the plan is funded. And some plans, if they reach a certain threshold, will have to file a form 5500 EZ for annual reporting. And that's typically if you reach assets of more than $250,000 in the plan. So solo 401k plan documents have to be approved and filed with the IRS and have very specific requirements. You can't just make this up. There are specific providers that have plan documents approved by the IRS that they can then use for solo 401k. So how do you get these plan documents? Well, that's going to depend on whether your solo 401k is a bundled plan or if using a TPA, which is short for third party administrator. So many investment custodians will offer what's called a prototype solo 401k plan. This means the custodian provides you with a set of basic plan documents that are IRS approved and ready to use. So anyone opening a solo 401k at the custodian uses the same basic plan documents. And the prototype plan documents are typically offered at no additional cost for the most part. And this can make the process very easy, very convenient, since you can set up everything in the same place. The downside can be that prototype plan documents provided by an investment custodian are typically very basic and don't allow certain features like loans and more customized options. So, however, they can work just fine for the majority of people setting up these plans. You can also get plan documents from a TPA, which again stands for third party administrator. This would be an unbundled solution. So in the context of solo 401k plans, a TPA plays an important role, although its involvement is typically less complex compared to traditional solo 401k plan or traditional 401k plans because a solo 401k is much simpler. So a TPA is an organization or individual expert in plan administration and compliance that manages various administrative responsibilities for retirement plans, which include solo 401ks. So for solo 401k plans, the TPA's responsibility can include plan documentation, which means, providing plan documents, keeping them up to date, and compliance testing can be part of it as well. So solo 401k plans are generally exempt from the non-discrimination tests that apply to traditional 401k plans because of their single participant nature. But, TPAs can ensure compliance with other rules and limitations if necessary. Reporting and filing, TPAs can file the 5500 form once the plan reaches a certain threshold. They can do contribution calculations for you to determine how much you're allowed to contribute. They can administer distributions and loans, and they can offer advice on plan design and general administration. If you use a TPA, you can generally set up the actual investment accounts at any custodian that offers the correct account types for a solo 401k. So again, this would be an unbundled solution because you're getting the plan documents from the TPA and then setting up the investment accounts at the custodian of your choice. The two components are independent of each other, although they do work together. So the TPA does charge a fee for setup and ongoing administration. So be aware that if you do an unbundled solution and go directly to a TPA for the plan documents, that's likely going to be an additional cost. So given the pretty straightforward nature of solo 401k plans, some business owners opt to handle the administrative responsibilities themselves, especially if they're comfortable with the requirements and they want to minimize costs. So, many people are just fine with a prototype plan and not using a TPA. So bottom line, if your needs are simple and you don't yet have a lot of money invested yet, a bundled solution with a prototype plan might meet your needs just fine. If your needs are more complex, you might want to opt to use a TPA. Side note, working with a financial advisor can be a great way to make sure you're setting up the 401k properly, the solo 401k properly, and that you're staying compliant. So don't be afraid to reach out. I set up tons of solo 401k plans personally, and I use a prototype solution from my custodian that works really well for a lot of people. And that's something I can help with too. So step 2, setting up the plan. So let's go on to step 2. Once you've chosen your provider, whether it's bundled or unbundled, the next step is setting up the account. And this is basically an application process. Paperwork, it's usually digital these days. You're going to fill out basic information about yourself and your business. The application form will be provided by the provider. Things like your business EIN, basic information, and you'll need to provide the plan documents. So if you're using a custodian that bundles prototype plan documents with the account, you're likely going to just sign everything all at once. You'll sign the plan documents during the process, all in one kind of step. If you're using plan documents provided by the TPA, you'll need to provide the signed plan documents to the custodian before the accounts can be set up. And if your plan documents and your custodian supports it, you'll generally set up 2 accounts, a traditional solo 401k and a Roth solo 401k. When I say traditional, I don't mean traditional like big company 401k. I mean pre-tax, traditional as in pre-tax solo 401k. So this is to separate the two types of contributions and to document what is pre-tax money and what is Roth money. The accounts are governed by the same plan documents and part of the same plan, but they're distinct accounts for record-keeping purposes, so you can know what's pre-tax money and what's Roth money. Sometimes a third account can be set up, and this is for after-tax contributions, but that's kind of beyond the scope of today's discussion, and that's for things like a mega backdoor Roth setup. So we're not going to talk about that, but be aware that sometimes there is a third account that can be set up if you want to do something more elaborate. All right, so next, determining your contribution amount. We've talked about this already briefly. So the contribution amount for the employee is subject to the 401k contribution limits for the year. By the way, be aware that you have to have enough earned income to support that. So, if you make $10,000 in a given year, whatever the 401k max contribution is, you can't contribute more than $10,000 to your solo 401k because you only have that much earned income. So again, in addition to employee contributions, the employer contributions are subject to 25% of self-employment earnings or 25% of salary if you're an S corp. Again, not to exceed the annual limits specified by the IRS for the given year. So step 4, making contributions. This is the part where you actually get to fund it. So, after you set up your solo 401k plan, you can contribute in lump sums. You can contribute in monthly recurring contributions, just like any other account. And you can transfer automatically from your business bank account into your solo 401k, and works pretty much like any other investment account. Pretty straightforward. So, regardless of the contribution method, you want to make sure you keep track of contributions and maintain accurate records, especially if you're not using a TPA. A TPA will often track these things for you. But if you're using a prototype plan, you're self-administering, the custodian generally does not track contributions for you because it's a plan. It's an account that's governed by an outside set of documents. It's a different kind of plan than, say, like a Roth IRA. A Roth IRA, your custodian is going to track how much you contribute and for what year. But with a solo 401k, often all the custodian sees is money coming in, and they don't really track what year it's for. And so you want to be sure you track that specifically for yourself. And again, a reminder, if you're an S corp going through payroll, make sure your payroll accurately reflects your contributions when you make them. All right, step 5, managing investments. Again, pretty straightforward, like any other investment account. You should have flexibility to invest in pretty much anything you want: mutual funds, ETFs, stocks, bonds, etc. So, kind of the same principle applies here with other investments. Check your time horizon. Make sure you're diversified. Make sure you have investments that are appropriate for your financial situation, et cetera. Once again, side note, if you don't feel comfortable managing your own investments, working with a financial advisor can help with that too. Step 6, down the road, at retirement, let's say you're taking distributions. Generally, it works like a regular company 401k. If you have pre-tax money in there and you're older than age 59 and a half, you can take your withdrawals and they're only going to be taxed at your income tax rate. If you have Roth money and you're over the eligibility age to withdraw with no penalty, then your money is in theory tax-free if the conditions are met properly. So as always, be sure to consult with a professional on, things like taking distributions and that sort of thing. All right. So that is the inside scoop on solo 401ks, how they're set up, how they're structured. And it's a really smart move for a lot of self-employed professionals who want to maximize retirement savings, have a very tax efficient way to save for retirement, and get a wide variety of investment options. And it's one of the best retirement plans available, in my opinion, to solo business owners. And it gives you lots of flexibility when it comes to managing taxes and saving for retirement. So again, if you're a solo business owner with no full-time employees aside from a spouse, it can be a great plan to set up. It's a really powerful retirement vehicle. So if you have questions about this, as always, you know where to find me. I'm at elevationfinancial.com. You can reach out there through my website. You can send me a note through the form, or you can book a consultation if you want to get a little more serious about potentially working with me. We can talk it over and see if it makes sense. Always happy to chat. So with that, thanks for joining me today. Have a great day. We'll see you next time.